For the first time, all three major credit rating agencies have downgraded the U.S. from AAA. Dr. Smith, can you explain why this is more than just symbolic?
Certainly, this downgrade touches the core of America's perceived financial robustness. Like a top student suddenly receiving a B, it isn't just about grades but about future credibility and trust in the U.S. financial commitments.
Interesting analogy. But how does this tie into the broader global economic context currently unfolding?
The downgrade coincides with shifting global power dynamics. Countries like China and Russia are challenging U.S. financial primacy by creating new economic alliances. These downgrades may inspire other nations to reconsider their reliance on the dollar.
A plausible angle, yet critics argue that these shifts are mere fluctuating trends. Why should investors be wary?
Though it might seem another temporary phase, historical patterns show that economic empires often face gradual declines before major shifts occur. As global debt ceilings expand, the recalibration of financial powerhouses becomes inevitable.
The recent downgrade begs the question, are gold and silver indeed becoming economic safety nets in turbulent times?
Absolutely, history shows that during crises, precious metals maintain value. In 2011, after similar financial turmoil, gold prices surged 15% in a single month, signaling investor flight to safety.
Yet, modern investments often prioritize digital assets over traditional metal security. What's your take on this perennial debate?
Digital assets like Bitcoin offer portability and ease of transaction unlike any metal beneficial in our digital age. However, precious metals have a time-tested immunity against inflation and geopolitical uncertainty.
So, are we witnessing a complementary financial strategy emerging, blending traditional and digital assets?
Indeed, a hybrid approach could be the future. As we embrace digital currencies, metals serve as anchors for tangible value amidst market volatility, offering diversified protective measures against financial upheaval.
With the U.S. debt reaching astronomical levels, how does this impact global economic stability?
The U.S. debt situation is akin to remodeling a home while ignoring foundational issues. It's unsustainable, with debt expected to reach $37 trillion, impacting not just domestic policy but global economic confidence in the dollar.
However, isn't borrowing standard practice in modern economies to fuel growth and development?
While borrowing can stimulate growth, the problem arises when the borrowing exceeds productive investment, leading to deficits that outpace GDP. A perpetual cycle of debt servicing could eventually stall economic momentum.
So, looking ahead, how can economies stabilize themselves given such volatility?
Nations must strategically downscale dependency on perpetual borrowing. Innovations in sustainable technology and diversified trade ties combined with fiscal discipline can buffer against economic downtrends.
As the U.S. faces downgrades and competition, what does the future hold for its economic leadership?
The U.S. is at a pivotal junction. Historically the torchbearer of economic innovation, it must leverage technological advancements and international collaboration to maintain its influence amidst shifting economic paradigms.
Yet, don't domestic conflicts and policy disagreements further hinder this potential for leadership?
Internal political dynamics indeed pose challenges. However, in times of external pressure, history has shown that the U.S. often unites to charter proactive paths forward. Navigating this turbulence requires rediscovering bipartisan cooperation.
Do you think other nations view this as an opportunity to redefine global economic power structures?
Indeed, emerging economies perceive this as a strategic moment to expand their influence. While they modernize infrastructures and economic policies, a reevaluation of alliances can behaviorally shift global order, marking a gradual evolution towards a multipolar world.